Okay, good morning to everybody. Today is the 20th, I think, right? Of November 20th, and we're going to sort of begin to cross over to the other side of the balance sheet today, as I mentioned in my announcement on Monday in the Brightspace sort of landing page of the course site. We're going to start talking about liabilities, and so in other words, it's the quote unquote equities side of the balance sheet. The left side of the balance sheet being assets, and then the other side being liabilities and stockholders' equity. So we're going to be covering that, and that's really essentially where we're going to go for the rest of the semester. I do want to point out the Chapter 11, which I got mostly through on Tuesday. It's difficult given the fact that this is a very lengthy chapter, as a lot of chapters are in intermediate accounting, both 1 and 2. And so, I'll probably be posting a supplementary video just to kind of round out the content and some additional commentary and insights on that sometime later in the week, and you can have a look at that. Again, that's posted under the module itself. I wouldn't be, personally, when I design courses, I don't usually put week by week. It's usually more by learning module, because sometimes the schedule is in flux. Sometimes things happen. But this would be the week under the Chapter 11 learning module. So it's a YouTube video link, and it's easy to get to, as you've all been seeing. So the due date for the Chapter 11 activities are for the SmartBook quiz and the initial posting to the discussion activity tomorrow, Friday. So you've got some time to work on that, and the homework by the end of the day this Sunday. So there's some time to do that. So in our discussions, I would just encourage everybody to make sure that you do the activity. I know that sounds like it's something I probably ought not to be able to have to say, but a lot of times people skip over it thinking it's a sort of meaningless activity. And but I can tell you, it's probably the easiest points that you'll learn in a lot of courses like this, where it's sort of a hybrid nature, where there's an internet aspect to it as well as an in-person aspect. Even though most students don't come at 10:30 on Tuesday and Thursday, that's fine. But nonetheless, make sure that you do the activity. So the quiz and the homework again are in Connect, and so you got until then to do that. So make sure you do that. If you have questions about it, let me know as to what your questions are. As to Chapter 13, I've deferred the due dates, and I started debating making these changes earlier on in the semester, but I didn't for whatever reason. So there are a number of changes. This is just, I've highlighted some of the changes in the due dates, but you can also see them if you ever want to know, of course. You can look at Brightspace, and they will also be synced up with Connect in terms of due dates. So for this particular segment, Chapter 13's SmartBook quiz in Connect is going to be due 11/28. I know that's the day after Thanksgiving, so if you want to sort of, budget your time accordingly, feel free to do that. And then the homework is going to be due on the 30th. The ethics case is going to be also due on the 30th. I've opened this module up some time ago. A couple class members wanted to see it and look it over, think about it, and all that. That's fine. I'll talk more about that on Tuesday. I'll give you a little bit more insights as to what's necessary. I don't think this is something that you ought to lose sleep over. I think that for the most part, most students do very well on this particular thing. But one of the things that we are really under mandate to do, both by our accrediting agencies as well as by the profession itself, is to talk more, maybe not talk more, but talk about ethics and focus on accounting ethics, and which really translates to business ethics, to be honest with you. And again, a lot of you who may have taken Principles 1 here probably heard us talk a bit about some of the scandals that were the accounting profession got itself involved in, willingly or unwillingly, who knows, in the early 2000s, which led to a pretty massive change in some of the regulation, particularly with regard to auditing. This course is not an auditing course, but again, financial accounting, financial reporting is definitely an element of the auditing function. So we'll talk more about this on Tuesday, if you want to go ahead and get started. I think the directions are relatively straightforward, but I'll sort of give some more input into that. Okay. All right, so I want to get into Chapter 13 and talk about what's going on there, and it's not as dense a chapter, and frankly, I think personally, I think this is a less complex topic than the asset side discussion that we had before, and so I think, and a lot of it, frankly, everybody here has taken an introductory accounting course, and so an introductory financial accounting course. So a lot of this is not going to be new, but we are going to sort of expand on it in a number of different ways, particularly with the various types of current liabilities that we're going to be covering. So in chapter 13, the main heading is current liabilities and contingencies. And we're going to get very basic starting out in terms of saying, what is a liability? What is a current liability? And how do we define that? We're going to talk, we probably will not get the contingencies piece of this until Tuesday. And I know we're all aware next week is Thanksgiving, Thursday that is, a week from today. And so we're going to miss a day. And so I'm going to try to do my best to go as quickly and as expeditiously as I can through the material. Hopefully we'll not have too much unsaid in class leading up to this. But we'll talk today about current liabilities and also, and on Tuesday, more about contingent liabilities and what those are. Those things which we may want to set up a liability for, depending upon what is happening. That's what a contingency really is. And so let's get into it and talk about what's happening. If anybody has any questions about anything, feel free to let me know. Before we get started here. And okay, so as I mentioned at the outset a second ago, that we're going to get very basic with the definition of what a liability is. Well, a liability, if you want a textbook definition, then this is it, right? It's a probable future sacrifice of economic benefit, or it's a claim on assets. That's another way to define it, and that is. And they arise from from obligations that resulted from past transactions or events. This is not that dissimilar from the definition of an asset. That is, probable future benefits to be received from past transactions or events, and that has current future service value. And so current and future service value. And we're saying they're probable and future sacrifices. In other words, a claim upon assets at some point. So we know we're going to have to pay it, so we're going to create a liability. Now, this is not always the case with some liabilities. And I'm thinking particularly about legal matters where there's litigation pending, and the company in question that we're dealing with here may or may not have a liability. And so the recognition of the liability really is contingent upon what's happening. The same can be said with regulatory actions by regulatory agencies where what if the government agency is that has a claim against the company or a particular complaint, it may create a liability in terms of what the firm has to do in order to sort of meet that obligation. So remember, we're talking about a sacrifice of some asset going forward in order to satisfy a liability. That's some claim that some outside party has on the particular firm in question. So a current liability then is hopefully this is not new information, is simply the obligation that's payable within a year or the operating cycle, whichever is longer. Okay, whichever is longer, and they tend to be satisfied from current assets, although that's not always the case. I mean, there are cases in which companies restructure debt and take out current liabilities and wrap them all together and do all kinds of things. But in general, if we're talking about, particularly if we talk about some of the examples of current liabilities, things like interest payable, wages payable, all these things are typically paid out of cash or very liquid instruments. And so as a result, and which are all current assets, by the way, as a result, this is not that incorrect of an idea. I'm just simply saying it's not exclusively that idea. And it's sometimes satisfied by the creation of other current liabilities. That is, we may swap one liability for another. So, and that's maybe less common, frankly, but it does happen. And keep in mind, any kind of a liability you can exchange for another liability as long as the parties involved are in agreement with it and it makes sense. And again, we're talking about transactions or events that make sense. And so we record them and such. And so when it comes to recording, we're going to record them at their present values. The only issue here is when we talk about current liabilities, in liabilities in general, we put at their present value, which sometimes is less than what the final amount is payable to the recipient is going to be. But in this case, on current liabilities, we usually record them at the maturity amounts. That is the amount that's finally going to be paid to the other side of the event or transaction. And we'll give a couple of examples here in a minute to show what we exactly mean by that. So what are some of the most common examples? Well, these are probably, there's no real surprise as to what some of these are. Accounts payable. Accounts payable are what we can also call trade payables. That is, we buy supplies, we buy materials, we buy inventory, whatever. from some supplier, and it's often done on credit. And the reason it is because it's sort of customary. And a long time ago, when there were long transit times, it was really difficult to sort of collect money right away. And you don't really expect the shipper, the trucker, the train company, or whatever, to collect the amount. Instead, there's a credit period. And we talked a lot about that in Principles 1, this idea of a credit period. But accounts payable or trades payables are there. Notes payable, or we're talking about short-term notes here. And short-term notes, and we're going to talk quite a lot about this idea of short-term notes and what they look like, particularly if we're talking about borrowing from a bank or other sort of institutional lender. They can also arise, however, from a supplier who will extend credit in the form of a very formal note payable, which is more formal, tends to be interest-bearing, and we're going to get to that in a second and talk more about that. Commercial paper, we're going to talk a bit about that as well and what that is. This may be a term that's new to a lot of people. This is basically unsecured credit that's extended between corporations, many of them non-financial corporations, where a company has excess cash, wants to do something with it in a very short-term basis. And there's some intermediary, some investment intermediary in the financial community that matches those two parties up. Someone has excess cash, somebody needs cash, and as a result, they exchange this. It's unsecured, it's pretty much unregulated, but it's a market that does tend to work when the broader financial system works in general. And there's a discussion in your text about where Bear Stearns, which was in fact a financial company, had some difficulties because of the fact that the financial system itself was sort of breaking down. But in general, commercial paper's been around a long, long time. It's one of those things that really sort of flies under the radar when there's a big market, and usually dominated by U.S. firms. And there's a great discussion in the text about sort of the history of CP and what it's all about. Also things like tax payable, dividends payable, accrued liabilities. One thing that I would have put on here is things like wages payable and interest payable, because those are clearly things that are going to be current liabilities. And wages and salaries payable in particular, which we're going to get to a bit later, are usually when you have a cutoff period for reporting. So we're going to cut off at a quarter or a year end, and we're going to sort of stop the action and create statements. But you've got accrued wages and salaries, and that's a very current liability. In fact, I would probably slide it up above accounts payable in terms of its time limits. Remember, we move up the balance sheet on both sides, really, based upon liquidity. And liquidity is this idea of simply liquidating something, converting it to cash, making it go away. And salaries and wages payable have got to be paid very quickly. As we know, workers cannot work on credit for very long. 2 weeks is about the only credit period. Workers are working on credit, but not very long. And so if there's a cutoff period, there's going to be salary and wages payable, in addition to things like benefits and payroll tax and all that, a lot of which we're not going to cover here, but which we do cover in other courses in our program. Also, things like current maturities of long-term debt, which we move up from the long-term liabilities to the current liabilities. And we're going to focus a bit more on that a little bit later when we talk about the fact that we have long-term debt that is maybe installment basis or it's bond debt, and some of it becomes due at different times. But as it comes due, and I'm talking about principal, not just interest. Interest payable is one thing. And by the way, that's another thing that should be probably a current liability. We're talking about transferring at least part of that long-term debt into the current liability section. So out of long-term liabilities into current liabilities, because it's going to be satisfied in that particular year. And remember, a year is sort of the standard, time frame by which we create accounting periods. We do, in the case of current assets and current liabilities, we use sort of the standard of within a year or the operating cycle, whichever is longer. The operating cycle is this sort of theoretical model where we buy inventory, we convert it, so we purchase things, we sell it and collect a receivable, we convert it to cash, and sometimes the operating cycle is days. Sometimes it's longer, sometimes it's not really inventory, sometimes it's fixed assets that are being created. We're building a submarine, or we're building a cruise liner or a hotel, right? Those are much longer operating cycles. And so, but you get the idea. The idea is the current section of the liability side of the balance sheet, as well as the current asset side for that matter, are delineated by the fact that one period is shorter than the other, and we sort of know, we see it. And there's really no doubt about things like accounts payable, wages payable, No one's going to say wages payable are a long-term liability. It just wouldn't make sense, and nobody in their right mind would say it. So as a result, that's how we sort of recognize these liabilities as they occur. Okay. All right. So we talk about recording of current liabilities. We have to keep in mind that there are all kinds of different types, and the one main one, I think, when we think of current liabilities, a lot of people sort of their minds sort of go to accounts payable, and accounts payable are simply obligations or payments due to suppliers of whatever. Often it's inventory, but it could be services as well. And there's an extension of credit given to the buyer. In this case, we are the buyer. This is our point of view. Remember, a lot of times in accounting, you have to remember what point of view we're talking about here. In this case, we're talking about a company that's purchasing services or goods, whatever the case might be, and there's an invoice that they've got to pay it in a certain amount of time. And without getting into things like discounts and whatnot, which we've already talked about, the idea is that there's some obligation, some claim on our assets that the supplier has of whatever it is. And typically we think of accounts payable as being belonging to the suppliers of inventory, but it isn't just inventory. And remember, the fastest growing part of the economy has been services, and services are are known by the fact that they really don't carry inventory, or if they do, it's sort of tangential to whatever the main line of business is. And so inventories, they're not an inventoriable business. They're not a merchandiser. They're not a manufacturer or a wholesaler or retailer or whatever. And so as a result, it's not always inventory suppliers. And so the accounting considerations are determining the existence in the first place. And here what we're talking about is there should be some sort of paper trail or documentary trail. The word paper trail is probably a very outdated term at this point. I get that, but some sort of supporting documentation. And supporting documents are very important everywhere in accounting. If we want to know what happened when, and oftentimes, sometimes auditors get involved in this in order to sort of reconstruct history. Sometimes if there's an error, we can't figure out what's going on, something that's really sort of a mystery, we go to the supporting documents and we find out what those are. And this is pretty much everywhere in the tax world. When it comes to things like payables, there should be some sort of invoice that's coming our way, and so we should look at that invoice, and it should match up some sort of business purpose by which that invoice is being created in the first place. Is it a shipment of inventory? And if it's a shipment of inventory that we've received, there's probably also a supporting document called a bill of lading, which is simply a document that's produced by the shipper, usually a third party, a trucking company, a rail company, whatever. It has nothing to do with the goods themselves. And they're simply saying, okay, here are your goods, sign, okay, goodbye, that sort of thing. But it will tell the buyer of the goods what it is that one is buying. And so that can be then researched as a source. And so, and once we know that it does exist, we record it in the appropriate account ledgers. And I know when we say determining existence, it sounds like maybe this is a little bit, I don't know, sort of not very rigorous in terms of thinking, but there are times in which cases in which companies, people inside companies have issued invoices to their employer, and then they pay invoices that end up in the wrong place. And it's because of the fact that it's a fictitious invoice in the first place. And so this is where the audit function comes in. This is where internal control comes in. It's an important aspect of it. And for those who are looking to study for the CPA exam, when you get into auditing, you'll learn much more about this idea of internal control and how we detect fraud, because fraud is not just perpetrated by outsiders, it's oftentimes perpetrated by insiders, maybe more frequent by insiders, I don't know. But you're going to get the idea that determining the existence is important. And once it's there, it's not every single invoice that comes in, every single payable has got to be scrutinized and run down to the ground. It's most of the time that's not the case, but it does have to be justified somehow. And so when it's payable on account, it's basically a credit instrument. When you buy a good or service from a supplier, you're basically being extended credit, which is essentially the time frame by which we have to pay it. So, and these are typically non-interest bearing, and the reason they're non-interest bearing is because they're fairly short term, 30 days, 45 days, 60 days, whatever. If there's interest being computed, it wouldn't be that much to begin with. And in fact, if anything, the interest may go the other direction, where a seller may provide a discount to the buyer, which means that the buyer actually is is sort of incentivized to borrow money in order to satisfy that in a quicker time frame because of the discount. And everywhere we see the word discount, we have to be thinking about the term interest. And I think that's something that I've talked about before. Okay. All right. So that's sort of the definitional framework for what accounts payable are, but also notes payable. Trade notes payable are these instances in which we're buying something from somebody, typically. It's usually a bigger seller selling to a smaller buyer, where there's an understanding that they really can't pay right away. And so, okay, I'm going to extend you a note. They tend to be a little bit longer, but still a current liability. Remember, within a year, these are not long-term 30-year obligations. These are simply saying, okay, 90 days, 180 days until you sell the inventory, for instance. And once you do, then you can pay us back with interest, because these do tend to be interest bearing. The thing about notes payable is they tend to be interest bearing, and even when they're not interest bearing, they really are, and we sort of impute an interest expense to that particular obligation, simply because of the fact that anybody who extends credit, particularly for longer time periods than say the normal payables of 30 days or whatever, they're going to want to be paid interest, because the fact they're out money or out value, I should say, for a period of time until that thing is collected on merit. One party's note payable is another party's note receivable, and so they are probably going to want to be compensated with interest. And we'll see some examples where the interest rate is not necessarily stated, but we have to sort of impute it, because the idea is that there should be some sort of interest that's involved in it. So, okay. All right. Let me see here. I get some sort of weird thing come up on my screen here, but I think we're good. Okay, so let's move on here to talk a bit about some of the issues in terms of how we record. This is an example of current liabilities. General Mills, which we all know, the big cereal company, and in millions, right? Remember, we chop off zeros, so this is not $2,119. It's $2,119,000,000, and these are the accounts payable as of this particular period. I don't know if this is the year end. It kind of looks like it is. And you might think, well, what, May 28th, May 29th? It could be. Some companies will say it's going to be the fourth Wednesday or whatever of May. Who knows why they do it? They do it for their own particular reasons. And so as a result, you're not always going to have an even year end. If this is in fact the year end, I do not know when General Mills's year end is. You can obviously pull it up. Their stock symbol is GIS, and you can find out when it is. But that's essentially what's going on. The key thing is here is you got accounts.
Really sorry, I didn't want to interrupt your class. Are you having any issues with Office?
Well, not right now. I'm not.
Not right now?
Not
Okay,
right now.
cool.
Yeah.
I just wanted to check that because
Yeah.
we're having some issues that is impacting all PNM.
We were yesterday.
Okay, but everything is working fine.
So far, so good.
Okay, good. I just wanted to check that.
No, fine.
Yeah.
Thanks, Louise. Okay. Yeah, we had some issues. Sorry about that. We had some issues with something with Office and whatnot. So that was our tech guy from the business school. So all right. So anyway, story of our lives, right? So we have accounts payable, and again, this is year upon year. But also notice one thing I mentioned earlier is the current portion of long-term debt. That is where we pull forward some of the amount that's due this particular accounting period going forward. So as every year goes by, we're sort of moving up the principal balance of these. Interest is going to be recorded as an interest expense, and as we pay these off, it's going to be simply, debit current portion of long-term debt, which is a credit balance. We're going to debit it, close it out, and we're going to credit cash, and that's going to be the transaction that makes that go away. Notes payable, what we were talking about earlier, that's the idea, is short-term notes payable, and that are owed to others, obviously the term payable, and so total current liabilities for this, and so and that's the example of what we're really getting at here in terms of talking about current liabilities. Okay. All right. So so we talk about this. This is an example of the notes to financial statements here. And so when we talk about the components of notes payable and their average interest rates, they're as follows. Okay. Now, one of the things, let's kind of go up here a minute. Notes payable is simply one line item right here. Boom. Right. This is the balance. This is a balance sheet entry, or it's an excerpt from the balance sheet from year end May 28th, 2017 notes payable. But let's drill down into it a little bit deeper here. And what are those notes payable? And what are they? Who are they payable to? And what's it all about? So let's kind of get into this. And I do want to get into this issue of weighted average because I think it's important for us to do a bit of a refresher on this. If you're not, if you're needing a little bit of muscle flexing on what weighted averages are, let's talk about it here. So the components of the notes payable is the current payables and the current liabilities. They're as follows. So let's just take 2017 here, and we have what? We have U.S. commercial paper and 954 million, and financial institution debt of 279.4 million. The weighted average interest rate is 1.1% for the commercial paper. You might think, wow, that's an extremely low rate. Why is it extremely low rate? It's because of the fact that it is a principle in finance. It's well established that the shorter the credit period, the lower the interest rate because the risk goes down. Risk and pricing of debt or pricing of any return on a financial instrument are directly correlated, as they're positively correlated. The riskier the thing is, the higher the rate of return that's demanded. And one element of risk is time. So a lot can happen over greater time periods than over lesser time periods, which is why current liability debt is not usually very expensive. Okay, now we got 7% here, so that's maybe high from today's standards, but maybe in the broader scheme of things, maybe not. We're kind of in a low interest rate environment. We have sort of been for a while now, so it's not that surprising. But I do want to get into this issue of weighted average cost of debt and how we get to it, because it may come up, and it's something that I do think it's sort of incumbent upon us to talk about as we sort of are getting into those who are going to study finance at some point in the future. So let's kind of take the information we've got here. So we have two elements of notes payable, that is short-term notes payable, and one is going to be U.S. commercial paper. So it's going to be commercial paper, which is not. This is as of 2017, right? Whereas we 954.7 million times an average rate of 0.01. We'll just sort of round it off at 0.01, and we have that payable to financial institutions, right? Probably banks, but it could be investment firms as well. In that regard, we have 279.4 at an average rate of 0.07. So if we do the math here, this is principal times interest, we're going to end up with 9.547 million in terms of interest expense from commercial paper. And when it comes to financial institutions, it's going to come out to be 19.533 million. We add these up and we get about $29.08 million, right? Which we then divide back into the amount of total indebtedness, which is 1.234 billion. And let's just kind of do the math here. Let's take 29.08, right? That's interest, right? Divided by 1.2 or 1.2 billion or 1 million, 1.234.1 billion, and that is principal. And we're going to end up with a number of 0.2356, which is going to be roughly 2.4%. Now, why are we doing this, and what does this mean, and why do we get to the weighted average interest rate? Because very often, everywhere, because we're increasingly, accounting is increasingly being integrated with finance, and accountants, as I've said a number of times before, are not really bean counters as much anymore as they are analysts and consultants, internal consultants. They oftentimes move into management, and one thing they're really trying to do here is that they're sort of trying to advise management as to what to do. 2.4%, is that a good weighted average interest rate on short-term debt? Probably. I mean, it's really based upon market conditions, but that gives you an idea of the amount of interest that we can expect to pay on our liabilities to other sort of institutional lenders in this case, whether it's a company that's extending a note payable or whether it's commercial paper or whatnot. And we'll talk a bit more about commercial paper here in a second, and also lines of credit, and talk about what those are and why those exist. So, okay. And then this compares against a weighted average interest rate the year before of 8.6%. So that's a big difference here in this example. And I mean, it's huge. So, and what is the difference? Well, it looks like the company was not taking advantage the commercial paper market, which is simply this. I don't want to say it's unregulated, but it's not as regulated because I think you get up to, I believe it's 9 months of an obligation to be extended. But that would be long. I've seen commercial paper being 1 day, 7 days, 30 days, where it's a company that just says we need $50 million and we need it for 30 days. Then they call Goldman Sachs and say we need $50 million or $500 million or whatever, but we only need it for 30 days and pay it off. And oftentimes they'll have some sort of backing with some sort of bank lines of credit, and that's the way that they can sort of assure anybody who's extending the credit, which is usually another company, and oftentimes non-financial companies. These are just companies with excess cash they've got to do something with. I mean, you can't park, hundreds of millions of dollars in a checking account that pays no interest. That doesn't make any sense. So you've got to do something with it. And so this is one area that's been developed and in corporate America, and it does supply those companies that need short-term liquidity. And by the way, almost every entity everywhere in the world sometimes has needs for short-term liquidity, whatever it is. No matter how wealthy you are, you may be tied up into some assets, and so you might need something liquid, and so you might need to go borrow. And it's we want to sort of overrule the idea that borrowing is inherently bad or problematic or is a symptom of trouble. It's just simply a symptom of a need for liquidity. And so this is one means by which corporate America sort of satisfies it. So here are some of the notes. To ensure availability of funds, we maintain bank credit lines sufficient to cover our outstanding notes payable. And commercial paper is a continuing source of short-term financing. We have commercial paper programs available to us in the U.S. and Europe. And you get the idea, and you can kind of read this. The key thing I want to focus on here is committed versus uncommitted credit facilities. Okay, so what are we talking about here? Well, since we're talking about current liabilities, we're talking about short-term notes payable through some sort of credit facility. What is a credit facility? If you've never heard the term before, you might use it in job interviews. If you're going in the financial world, it might make you sound smart. It's simply any sort of structured finance, sort of structured financing program, whether it's short-term, like a line of credit, whether it's a long-term loan, whether it's a mortgage, instrument or whatever. These are all what we call facilities, and they all differ from one another in terms of how they're structured and whatnot. But and so a lot of times in loan agreements, bankers will say this particular facility is going to be priced at this rate, and this particular facility is going to be at this rate, and there are all kinds of different terms attached to them. But the key thing here is not the issue of the term facilities, but rather committed versus uncommitted. When we talk about committed credit facilities, we're talking about, in this case, the current liabilities. Remember, there's a lender on the other side who will treat it as a current asset, right? It's that sort of mirror image everywhere in accounting. So we're the borrower here, we're the company, we're General Mills. There's going to be some lender out here somewhere that's going to commit us to a credit line. And the line of credit, when it's committed, means that we've established a formal loan agreement. It sometimes expires within a year, but sometimes longer. Sometimes, and it's usually subject to review. The bankers like to review things annually as financial statements come in, which is one reason why accountants are required to produce financial statements, so that external users, i.e., in this case, bankers, will have to look at it and say, what's going on? Maybe we want to extend this facility, maybe we do not. But if it's committed, it's simply saying, these are the terms, this is the interest rates, prime interest rate plus 1% or whatever, or 0.5%. And it's going to be collateralized this way. And it's all these kind of terms that go on. Those are committed credit facilities. And usually the borrower has to maintain what are called compensating balances. That is usually checking account balances that sort of compensate the lender, because the lender can use that money, interest-free, to do whatever they want with it. So it's one way of compensating the lender. And there's also some sort of fee that's involved. It's usually some percentage of the line of credit amount. And the bigger the line of credit that's established, usually the smaller the fee is, just simply because it's a cost of doing business. And by the way, I think we as accountants would treat it as interest expense because it's a cost of financing. So that's what a committed credit facility is. We're talking about a line of credit. A line of credit is basically where it's not that if you have a MasterCard or Visa or whatever, you have, say, a $5,000 credit line on your MasterCard, right? You buy furniture for $2,000 and you have $3,000 left. You pay the $2,000 off, you get $5,000 back again. It's not at all that different. It really is not in terms of how it works. Maybe And the payment on this usually is interest only, usually on a monthly basis. That may differ from a little bit from how your credit card works, but that's not all that different at all. That's a committed credit facility. What is an uncommitted credit facility? This is where it gets a little interesting. Usually it's a little bit smaller of an amount, and this is one where it's a more informal obligation, or, well, I shouldn't even say obligation on the part of the lender. It's not really, it's more where bankers say, and we are talking about commercial bankers here primarily, we're going to give you a line of credit, and we're going to call, and it's going to be 500,000 or $5 million or whatever, but we're not going to charge you anything up front. It's there if you need it. And it's what we as bankers used to call a guidance line. And there's sort of an internal fiction among banks that we're not supposed to advise clients of these, but we always do. We can tell them, you got $5 million if you need it, it's available at a rate of prime or whatever, right? And so all you need to do is give me a call and we'll move it into your account. No big deal, easy peasy, right? But we're not going to be committed to it if things go wrong because there's nothing in writing or whatnot. So, and this may differ from what you may have heard in business law, that an oral agreement is binding. Well, okay, I think bankers take their chances here, but when we're talking about guidance lines, we're talking about the need to have some sort of facility available in order to fund short-term needs. Now, why would this happen here? And why would a company want to record it as uncommitted? It's because of the fact that a lot of times companies need money quickly, and the more outstanding debt you've got, it becomes very difficult to get money very, very quickly. If you're a big borrower, that thing's probably got to go to some loan committee, which meets once a week. So if you need it tomorrow, that's, do not call your banker on Tuesday expecting money on Wednesday. That's probably a good rule of thumb anyway, unless it's maybe a car loan or something like that. But it's usually not very good unless you have it set up as some sort of uncommitted line, in which case that's a different thing. And so, but this is not extended to everybody. This is extended really to the good borrowers and whatnot. And so when we talk about short-term financing, banks have sort of been edged out of the market for short-term financing. A lot of it due to the commercial paper market because it's much cheaper. It's a lot more hassle-free. It's unsecured. There's no collateral. There's nobody personally guaranteeing anything. And so banks do establish credit lines because of the fact that they've got lots of money to lend. And it's very, very quick if you're already established. And so even the very biggest companies have lines of credit with banks, if for no other reason than to make payroll. That's one thing that's completely non-negotiable. Your workers have got to be paid on time. And there's no way they can say, hey, workers, we're the biggest company in the world, but can you wait a day to be paid? The answer is no, we cannot do that. So a lot of organizations need short-term financing needs. Lines of credit are a very important mechanism by which that happens. And so they're sort of set up in order to do that. And by the way, they tend to back up the ability to borrow from the commercial paper market because, if we're borrowing $50 million for 7 days or whatever, we can say, well, we have $200 million available on line of credit at JP Morgan Chase. And so if for whatever reason we can't pay you off because we are not collecting receivables as quickly, we will hit this line and we will pay you off and you are fine and whatnot. And so, that's sort of a bit of a backup in that regard. Okay. All right. So that's what the difference is between committed and non-committed. One is formal, one is very much laid out. And it's usually in a very strict, informal, contractual written agreement that parties sign, usually signed by the CFO of the borrowing company and the lender itself. Okay. All right. Quick quiz. Which of the following statements is true about current liabilities? Current liabilities are obligations payable within a year of the firm's operating cycle, whichever is longer. That sounds true. B, current liabilities are ordinarily recorded at maturity amounts rather than present value. That's true. C, current liabilities as those expect to be satisfied with current assets or by the creation of the current liabilities. That's also true. So all of the above is true in that regard. All of those are characteristics of what we would term current liabilities. And so let's talk about notes payable here. This is this looks, I don't know what this is, cocktail glass or whatever, where you've got different forms of financing that all take the form of notes payable. These are not accounts payable. These are not wages payable or whatever. These are simply obligations payable, usually to other sort of what we call institutional lenders. Commercial paper would be General Mills, maybe borrowing from, who knows? They may not even know who they're borrowing from. Could be they're borrowing from Ford, right? Again, commercial paper is usually non-financial entities sort of swapping paper back and forth, cash and paper through an intermediary, investment bank, Goldman Sachs, Morgan Stanley, whomever. And as a result, it's a way to sort of meet short-term obligations. There's interest involved, and it's considered fairly low risk. And again, the issue here is it's an important component of short-term financing. Also, unsecured loans, these are simply borrowings, typically from banks, but it can be from whoever. Credit lines also typically from banks, and also secured loans. The difference between secured and unsecured simply refers to collateral. That is, what kind of property is being put up, what kind of assets are being put up and pledged for collateral. Meaning that if there's a default on this obligation to some debt holder, for whom they'll note as a receivable, but to us as a payable, then they can move in on the assets which we've identified as being available for them to sort of seize. And most creditors do not want to go to this step because usually when we get to that point, it's things have gotten very, very bad, and there's interest and principal for that matter have long ago ceased to be being paid. And I think nobody really likes to collect on the collateral, and we always sort of looked at it as being really sort of just a backup, isn't it? It's sort of an attention getter. We have the right to take your inventory, the right to take your receivables, whatever, that sort of thing. So, okay. And so, again, the rule of thumb of finance is the shorter the obligation, the lower the rate of interest, simply because of the fact that less can happen in short periods than long periods. Over long periods, a lot of weird things can happen. And so as a result, that risk, and again, the term risk in finance simply implies or simply is defined as the variability of outcomes, the uncertainty of outcomes. Either good or bad, either one, by the way. We just don't always know what the outcome is going to be. And so the higher the risk is a statement of recognition of a higher uncertainty of whatever the outcome is going to be. And so as a result, anybody who's extending credit in this case wants to be paid more. Okay. All right. So we talked about lines of credit, and there's not much more to really say about this. Other than the fact that committed lines, there's a formal agreement. There's often a commitment fee. It's just basically an upfront fee paid to the lender. It's recorded as an interest expense on the part of the borrower, interest revenue on the part of the lender in this case, right? And a non-committed line, or what we call guidance lines, are much more informal, and there are no formal loan procedures. And this is where very good borrowers will call the bank at 10 o'clock in the morning and say, I need $50 million today. And there's no need to go to loan committee and get this thing approved because it's already been approved. 50 million may be a lot for having they can line. But it wasn't the company that way. Maybe back in the day it was, maybe not so much now. And so as a result, okay, it's available, and how do you want it? And I'll fax you the documents or email you the documents. You can sign it, send it back, put it in your account today, right? And that's the one benefit of these non-committed lines is the fact that you can sort of get out of formal loan procedures. It doesn't mean that the lender itself doesn't approve it, because they do. It's just it's not formal, and it can be withdrawn at any time. And when they borrow, they've got to pay it off, based upon normal credit terms at whatever interest rate is sort of specified. If the borrower doesn't like it, well, then they're the ones calling at 10 o'clock wanting money today, so they've got to kind of deal with it. So okay. All right, IBM is an example here of a note to financial statements. And so in 2016, I don't want to read all this, but the company increased the size of its 5-year credit agreement to $10.25 billion and all that. So, and all this is really simply saying is the idea that we've got borrowings out. And notice the financial statements, I've said this many times before, they're extremely important because they sort of tear down into these line items on financial statements and show what's going on. What are we talking about? We have $323 billion in notes payable. What are those notes payable? What's the composition of it? Who are they owed to? And even non-public companies, accountants will produce this information as a note to the financial statement saying that Jones Plumbing borrowed $50,000 from First National Bank at a rate of 8%, payable in 2 years, or whatever. And so this idea of disclosure is something that in the accounting world we do all the time through notes. Even if it's a non-public company, even if it's an unaudited company, these are disclosures that are made for the benefit of users. And that's essentially, as we've said a gazillion times before, really what the main purpose of financial accounting is to be able to explain to users what the heck is going on. Okay. All right, so any questions? Anybody here in the room or online have any questions? Okay, well, let's talk about interest and what is going on with interest. And I brought the lights up a bit. Did I move the camera back to the screen? I think I did. Okay, so when we talk about interest. Okay, thanks. All right, feel free to enter in the chat box if you have questions. I try to use it when I'm sort of floating around the room here. But let's talk a bit about interest and what it is. So interest is simply the cost of borrowing. I think we know that. I think this is not some great secret as to what interest is. Economists will call it the rental cost of money expressed as an annual percentage rate. It's a pretty good definition, the rental cost of money. I've got money I need to do something with, and I want to get a rate of return on it. I'm going to lend it to you, and you're going to pay me a rate of return on it for the use of my money. And it's, in other words, they're renting money. And that's essentially what interest is a rental cost. And it's always, 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 always expressed in annual terms. And I know I've said that, maybe I'm being a little bit extreme in my emphasis here, but I know a lot of times, even in my own professional practice, sometimes people would say, is it 6% per quarter or 6% per month? No, no, no. Every interest rate is expressed in annual terms, always, 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 right? Loan sharks will deal with interest per week or whatever. But we're talking about the legitimate world here. We're talking about the corporate accounting world. That's not. We're not talking about loan sharks. And so we're talking about this very interesting formula. Simply principal or face amount times rate times time. This is simply principal times rate times time. This is a dollar figure. This is a percentage. This is a time, always expressed in terms of annual terms. And so if it's an 18-month loan, it's 1.5 is the term. If it's 6 months, it's going to be 0.5. It's always expressed annually. And so the interest rate is simply determined as I, which is out here, so it equals P, principal, or face amount times rate times time. I equals P times R times T. Okay, and it's always an example of that. The accounting for this actually is easier when it comes to corporate accounting here in Infinite, which is what we're doing here essentially, than it is for consumer accounting because there are fewer disclosures. It's a fairly straightforward thing. It's not really that complicated at all. And in fact, the math is easy, and so is so are the journal entries. And so it doesn't get a lot easier in intermediate accounting than this. So on May 1st, Affiliated Technologies borrowed $700,000 for First Bank Corp under a non-committal line. Okay, issued a 6-month, 12% promissory note. Okay, so 700,000 at 12% is for half a year. Okay, so initial entry on May 1st is going to be cash debit, increased cash, notes payable. Boom, easy peasy, right? And then on November 1st, which is that when it's paid off? What's the payoff? Oh, 6 months, yeah. So November 1st. All right. So what is 700,000 times 12% divided by 2, because it's only 6 months? It's going to be 42,000. So interest expense, which is a debit, it's an income statement account. The note payable, which is over here, it's a liability, is now zeroed out because we're paying it off and we're paying it off with cash, 742. So boom, it's done. That obligation has been recorded. It's done. It's in the books. And that's it. Easy. Nothing terribly complicated about it, right? And there's really nothing more going on. The only thing that may be different is if there's like a fee being paid to the bank corp or whatever, which we could add to the note payable or whatnot. But in this case, it's a non-committed line, and I think that's one of the reasons why the textbook authors call it a non-committed line because there's no fee involved here. So there's nothing like that. It's just simply, hey, I need 700,000. I'll pay you off in 6 months, and so okay, it's 12%. Okay, this is it. This is what it is. Now, typically, these are variable rate loans. A lot of short-term financing is based on variable rate, tied to something called the prime rate, which is usually tied to the very lowest interest rate that financial institutions pay each other overnight. So you heard the term prime rate. There is no prime rate. Could be, I could create if I'm a banker, I could create whatever prime rate I want, but it typically sort of matches across the economy. There are some banks that may differ higher or lower than whatever the prime rate is. But nonetheless, it's usually on a prime plus sort of schedule and whatnot. And we'll talk a bit more about this idea of how we add to some sort of index, which is some sort of reference value as we do what's called pricing. Okay. All right. So that was the interest bearing note. Pretty straightforward. What about the non-interest bearing note? Well, here we're going to assume that all the facts are the same, except for the fact that affiliate is borrowing with no interest at all. Okay. Well, they're borrowing from a bank. Now, banks don't lend money at zero interest. It just doesn't happen. So we know there's going to be interest involved. And so in this case, they're buying inventory with 658,000, which is going to be booked into inventory as an asset. And then there's going to be notes payable at 700,000. Remember, we booked these at maturity value, which is going to be 700,000, right? And so to make this balance, there's a discount on notes payable. This will be the interest expense in 6 months when it's paid off. But what we're doing is we're discounting this particular note by 42,000. Again, the word discount is to be thought of as suggestive of interest. Pretty much everywhere you see the term discount. You can compute it to some percentage, and therefore it's a financial concept that says this is the amount that we're ultimately going to be paying. So on November 1st, the same facts apply. They're still going to be paying 700,000 the amount, but they got less to begin with, right? And less in terms of value for the inventory. They're going to still be making a cash disbursement, right? And they're still going to be paying interest expense, although they're going to be wiping out this note. The only difference is they got 700,000 in cash up front earlier. In this example, all we're doing is discounting it, right? Now, if they needed 700,000 in cash up front, we would simply raise this amount in order to accommodate that situation. But in this case, we're trying to sort of simplify the math. And so as a result, interest expense is recorded here because it's been earned. This is an accrual system where it hasn't been accrued until it has been accrued, 6 months. So it's recorded, and the discount notes payable is zeroed out. And as a result, the note payable is also zeroed out. There's a credit balance, now it's a debit. We pay 700,000 credit in order to remove that liability, and that liability is debt. And so that's all gone from the picture. So what's going on here is the idea that there is a non-interest bearing note, okay? Pretty much everywhere, unless it's extremely short-term obligation, or maybe some sort of nominal, amount and whatnot, something we would not consider material, we're always going to sort of impute an interest rate based upon market conditions and what we think the rate ought to be. And so in this case, it's sort of looks like it's been predetermined for us. We'll give you 658,000 today, and you pay us 700,000 in 6 months. Well, that's sort of determined as to what it is, right? So it's pretty straightforward. This kind of situation doesn't arise as much anymore as it used to. It used to be when I first started banking, we had a department called discounting. That was what they did, was they put notes on the books. And it's based upon this idea of discounting is the idea that we're going to create a discount to the note that's going to be payable or receivable to us as the lender, payable to the lender, and that's going to represent interest expense to the borrower, interest revenue to us. And so discounting is this idea of simply saying we're going to discount the note that's going to be payable. The difference is then going to be interest, and that's simply the rental cost of money in the short term. Okay, and again, the short term notes payable is going to be carried on the books at its maturity value, and that which is this thing right here, right, at the origination of it, because it's a short term obligation. Okay. And so for the non-interest bearing note, this is something that we should talk about the effective interest rate, because this is something that is the actual amount of cost to the company in percentage terms. We know what the dollar figures are, 42,000, right? But we don't know what the percentage cost is. And so if we take 42,000, which is the amount of interest, divided by the amount borrowed, which is 658, right? We get 6.38, not 12 divided by 2. 12% is the annual rate divided by 6 months is going to be two times, or it's going to be 6, which is divided by 2, not multiplied by. Divided by 2 is going to be 6. Well, it's going to be 6.38. It's because we have a discounted amount here. And so as a result, this is what we call the effective rate of interest. The effective rate of interest. This is the actual cost. And this is something that is, by the way, not even really disclosed in terms of consumer transactions, which are more fixated on APR, which does not really include the effective rate of interest, which is something that for those of us in the financial world has always been sort of a mystery, but it came out of the truth in lending laws in the 70s. When it comes to commercial transactions, though, we're assuming the borrowers are sophisticated and that they know what they're doing and they can compute for themselves what the effective rate of interest is, okay? And in this case, it's simply interest expense over the amount borrowed. Very simple calculation, but it's going to be greater than what we call the nominal rate, which is sort of the official rate you see on the obligation itself, okay? or is implied if it's if it's a non-interest bearing sort of situation. Okay, and so we take that times 2, which is 12/6. We get 12.676 as effective interest rate. So it's not 6%, it's 6.38 for 6 months. It's not 12%, but it's 12.76 over the entire year. If we annualized it, and this is something that we do a lot in finances, we say, okay, on an annualized basis, what does this really mean? And I know when I was doing trading, I was working for an investment firm, and we would get like a 1.4% return in like a month, and we would say 1.4%, that's not very much. But if we multiply that by 12, then it becomes a little bit something bigger. And so annualizing it makes it a little bit more real, because everything in finance and accounting, when it comes to percentages, is based on annual rate. So that's how we annualize these rates of return. Okay. All right. So any questions about this before we get into the issue of secure loans? And we're doing pretty good on time here. This is, again, I do not think this is all that tricky of a chapter. But I do want to sort of give a little bit of context and depth to what is what's going on here. So we've talked a bit about obligations that are payable, typically to banks, but could be to other suppliers, could be other companies, on a short-term note payable. We are typically talking about bank financing. Now, this is not going to be the same discussion we're going to have as we move down the right side, the equities side of the balance sheet, because when we talk about bonds, that does not really involve commercial banks. It's more investment banks and the investment community larger. So for right now, we're really talking a lot about is bank financing. So when we talk about secured loans, all we're simply saying is security simply means the collateral that's being put up, the property that's being pledged as collateral. Pledging is simply the act of saying, okay, lender, you can attach these assets if I don't make good on the obligation that we're referencing back to here. Usually these are boilerplate documents. We usually have stacks of these that we would just simply have people sign, and we'd say, okay, all your accounts receivable here, they're pledging. All of your inventory you're pledging. All of your equipment you're pledging. And these were sort of blanket agreements. And then what we would do is we'd file what are called financing statements with usually state authorities, sometimes local authorities. It was a vehicle, it was a different sort of situation, but that's essentially what's going on. The firm itself is pledging these assets. This needs to be disclosed to users, and so if there's any kind of financing that's going on, this is something that should be recorded in the notes that we're pledging as collateral or inventory, accounts receivable, and whatnot, and so the lender has a claim on those. But it's a claim that only becomes effective in the event of default. And then if you're current on your obligation, you're meeting all other obligations, the lender's not going to move against these assets. It's not something they really want to do. They really do not want to do it, to be honest with you. But it's a lot of bankers will say it's an attention getter as much as anything else, and so that's kind of what's going on there. So, and by the way, I've seen borrowers in wild default of a lot of other terms of agreements, like maintaining a certain current ratio or a certain debt to equity or whatever, and we have not really moved against their collateral. It's just not something. As long as they're current on the obligation, usually lenders are extremely reluctant to go against collateral, because once you do that, I mean, the business relationship is over. It really is. So there's nothing more to talk about at that point. So it's more an attention getter. When we talk about factoring, we got to this a little bit on the asset side. When we talked about, hey, we have receivables and we need to turn them into cash, and maybe the company itself does an inadequate job of collecting receivables. And so maybe it's easier for us to simply say, hey, we'll sell you our accounts receivable. That is our debt owed to us by our customers that we've sold on a short-term basis. And maybe they're paying and maybe they're not, but maybe you guys can do better. And we're going to sell them. That process is called factoring. And factoring is simply some company is out there that buys the receivables at some fraction of the price or some fraction of the amount, and they collect them on their own. And if they do a better job, they're well compensated for it. And they're a little bit more aggressive, frankly. When it comes to business relationship, I'm selling to a customer. How aggressive do I want to get? Hey, you're 31. This invoice was due 30 days. It's 31 days. Where's my money? Do you want to do that, right? If it's 45 days, do you still want to get aggressive? These companies are a little bit more aggressive because there is no business relationship between the the holder of a payable, which is a receivable to the original seller, all they want to do is get paid. So factoring is it's a pretty common process. These are usually very specialized companies that do this, and they know what they're doing, and they know how to handle it, and they know how to sort of evade some of the issues that come up between the buyer and seller. And so, and again, even there, the original relationship might be impaired. So, but that's what a secured financing is simply when there's any kind of property, some sort of asset that's being put up to support the loan itself, so the lender can collect in the event of default. Okay. All right. I want to talk about commercial paper. We got about 15 minutes left. So commercial paper, I already talked a bit about it and what it is. It's typically unsecured, usually various denominations. They go 25,000. I guess there are individuals out there that buy commercial paper. It's not really that. My experience is mostly institutional lenders and borrowers, and it's a pretty informal market in a lot of ways. It goes on all day long. Controllers and treasurers. Treasurers are the people who basically control the cash for a company. Treasurers, that is. And so they're usually on the phone paying off or buying this debt on a very short-term basis. Beyond 270 days, it requires registration because it becomes a security. So it sort of evades that. But these are very short-term, sometimes as short as a couple of days, right? And the interest rates are extremely small because there's not very much risk involved, right? We're talking about established companies. Amazon is borrowing, $200 million and from, I don't know, IBM or Apple or whatever, right? There's no doubt about the fact they're going to get repaid with a little bit of interest. And so, you get the idea. It's not that big of a deal. And oftentimes the backing, this is not really specified in this slide, but the backing is the borrower will usually have a line of credit backing them. This is not the lender. Why would the lender need it? But it needs to be specified as the borrower that says, if I can't repay you, I've got a line of credit with JP Morgan Chase or Citibank or whomever, and I can go borrow the money and I'll pay you off. And so we're good for it. Okay. And these companies want to really maintain their their credit standing. I also put your text also has an interesting discussion, and it involves Comcast as one example. And so what I did was I pulled up Comcast's 10K report, okay, from the Edgar filing site. So Edgar, which again is the SEC website that is available to anybody, and Edgar simply stands for Electronic Data Gathering and Retrieval. Pretty boring acronym, but it's the SEC, and companies file their 10K reports, which are the annual reports, with them, so anybody can look at them. So let's take a look at Comcast, right? And in this case, all I really want to focusing on here is the notes to the statement by which they are explaining to their explaining to their investors or any interested party what's going on. So they have revolving credit facility and commercial paper program. We entered into an $11.8 billion revolving credit facility with a syndicate of banks. And the reason why there would be a syndicate is simply a collection of providers that get together because they don't want to take on the whole thing all at once. $11 billion is a lot of money. And even for some of the bigger banks in the country, do they want to do $11 billion in a short-term loan? Maybe not. They may want to get in with some others as well. And so this is not uncommon at all for financial companies to go together. We may increase the commitment to 14.8 billion, and the borrowing margin. This is something I talked about earlier. Is something based upon what's called the SOFR rate, which is the secured overnight financing rate, which is a very short-term interest rate determined really by the Federal Reserve of New York, which is sort of the main Federal Reserve bank in the U.S. outside of D.C., and so which is going to be 0.875. Which is 0.875 over that rate, whatever that rate is, which goes up and down. Okay. And then the big thing is our commercial paper program is supported by a revolving credit facility and provides a lower cost source of borrowing to fund short-term working capital requirements. And so this is basically just an explanation as to what we're doing with our short-term financing. Because prior to this, all you've got in the financial statements, you go all the way to the top here. This is a Comcast report as of December 31st, 2024. And you simply go down here to the financial statements. Let me see if I can find it here. corporation financial statements, okay, and we go to the balance right there, the consolidated balance sheet. Couldn't find it for a minute. All you really got here is these payables here, right? We got accounts payable and other debts, current portion of term debt, and it's really not explained as to what is really going on. This is a very, very scaled back example of what a balance sheet looks like. So in order to sort of flesh this out, they don't even talk about this as notes payable. In fact, they break it out as payables and other accrued expenses to trade creditors. Deferred revenue is one thing; it's a deferral. We'll talk about that here in a second. Other current liabilities, $10.6 billion. What is that, right? They don't even say what that is. And so this is where the notes to financial statements come from. Remember, they talked about the fact that they had this amount outstanding currently, but it doesn't even say what it is. And so this is why the notes to the statements are really important, because they sort of break out what these are. And so if we, and by breaking them out what they are, we simply, and the good news about the internet, we simply can go and simply hit the highlights here. We can go to financial statements, and we can go to debt, and we can sort of scroll down, and we can get to what's going on here. Boom, where we are. And so that kind of fleshes out for us what we sort of need to talk about. So again, the idea of disclosing what's happening is important. It's really a mainstay of the work that financial accountants are needed to do. Okay. All right, quick quiz here. Jamal borrowed $100,000 on July 1st, 2021, signed a one-year note bearing interest at 8%. Interest is payable in full at maturity on June 30th, 2022, which is basically a year down the road. So Jamal should report interest expense as of, and we're assuming Jamal is a company here because not just an individual. How do you report this otherwise? So it's going to be principal times rate times time. 100,000 times rate, 0.08, times time. And so as a result, what is that amount? Okay, well, let's just kind of do the math here. It's again, the math, as I said before, is really fairly simple. And so as of December 31st, if you were reporting statements, we'd be 6 months in. So it's principal, 100,000 times rate, 8%, times time, always expressed in annual terms, 6/12 of the year, 1/2, so $4,000. Okay. And we're assuming this is business reporting. I can't imagine that individuals would need to report to anybody if it's a car loan, whatever. But so this is what you get the idea of: principal times rate times time. Principal times rate times time. This is always going to get you to the amount. And if it's say it's 6 1/3 months, we can take whatever number of days that is divided by 365, and we'll get the correct amount. Actually, bankers tend to use 360 days, but it gives you the same place essentially, and that's how we essentially solve that problem. Okay. All right. Real quickly, we got 5 minutes left. I think we're going to get through a lot of this. Accrued liabilities. So these are things, these are expenses that have been incurred but not paid. These are accruals. Okay. These are accruals, and so remember, we have to offset accruals with adjusting interest. Accruals are these things which are going on but are not generating some sort of source documentation. They're not triggering something, but we have to bring them current. Whether it's accrued interest, right? Interest is accruing if we have a debt, a short-term debt, or long-term for that matter. But in this case, we're talking about short-term debt. Interest is accruing as we're sleeping, as we're going about. There's no event until it's payable, but we have to bring it forward because if we're cutting off the statement period, we said, okay, we've accrued interest, it's interest payable. And that adjustment is an adjusting entry. So in other words, we debit interest expense and credit interest payable if it's not been paid yet, right? And that's simply that's an adjusting entry. And again, as I've said numerous times before, adjusting entries deal with not just accruals like this, where the money follows later, but also deferrals where the money comes first. And so remember, we have two adjusting entries oftentimes deal with these two different types of events, deferrals and accruals. Deferrals is where we pay for something up front, or some money has been exchanged hands, and we'll adjust it later once we've either earned it or incurred it. With accruals, though, it's something where the money falls in later. So we haven't paid the interest yet. We're simply accruing it. So we have to bring it current through an adjusting entry. Okay, so that's in the case of an obligation that bears interest. So that would be interest payable. on this right here. But it's also, as I mentioned before, salaries and wages payable, where we're approaching a cutoff period. And so as a result, we workers that our payroll, next payroll period is January 7th, and the year cuts off on December 31st. It's 2-year pay, 2-week pay cycle. So as a result, we're going to have some payables for a week that are going to be payable going forward. And once those workers have earned it, so we're going to sort of carry that forward. In the middle of the accounting cycle, it's very easy. It's simply salaries expense and debit salaries expense, credit cash, or debit salaries expense and insurance expense and payroll tax expense and all these other things that go in payroll without overcomplicating it. Credit cash, right? But you probably wouldn't have a payable, a balance sheet item, a current liability, unless you're carrying that figure over across accounting periods, and so it becomes payable at that point. And it's an adjusting entry. There's no, you haven't written a paycheck for 1 week, you still owe for that week, but you'll pay it next week, but that's in another accounting period. And so you're going to carry it forward in the form of a payable. Okay. All right. Then a couple of things, and we'll go here, and that's a note with accrued interest. And so and same, it looks like the same facts as before with affiliated technologies. On May 1st, this company borrowed $700,000 under a non-committed short-term LOC line of credit, issued 6-month 12% promissory note, interest payable at maturity, so there's no interest. Now, by the way, in reality, companies typically are required to pay interest at least quarterly, but let's just kind of go with that. With the example here, assuming the fiscal year is on year end is June 30th, 2 months after the 6-month note is issued, how do we record it? Well, the debt was issued on May 1st, and so cash $700,000. We borrowed $700,000. We have a $700,000 note payable, but we need 2 months of accrued interest, and so we're going to take $700,000 principal times rate 12% times time 2/12, and we're going to get $14,000 interest expense and interest payable. We haven't paid it yet, so it's an interest payable because this is the year end, just like the wages payable example. We haven't paid it yet, so we got to set up a credit balance for the payable. It's a current liability. It will be retired, not in a year, but soon, right? But it's anything within a year, we're going to create as a short-term payable. Okay. And then I think the final bit of this is what happens when they pay it off, which is in 4 months hence. And so in the new year, there's 4 months left remaining on that. So 700,000 principal times rate times time is 28,000. They haven't paid any, they still owe 14,000 from the year end. So it's still payable that they're now going to pay off, and they're going to reduce. So they're going to take that credit balance. Right, let me go back here. They're going to take that. Oops, what am I doing here? Hold on a second here. They're going to take that credit balance, and they're going to zero it out with a debit balance of 14,000 plus the new interest accrued and the principal amount payable. So they're going to credit cash for 742,000. And that obligation is now satisfied. So that's what's going on there. Okay. All right. Well, I think we're pretty much out of time here. So when we come back on Tuesday, we'll talk a bit more about obligations. And we'll talk a bit more about this idea of accruals and deferrals and how we deal with them. Remember, deferrals are where the money comes first and the event comes later. We don't record the event until the event actually happens because that's what accrual accounting deals with. Accruals, the money comes later, the event happens first, like accrued interest in this case. The interest is accruing, but there's no, we're not getting a text message. We're not getting a letter to the mail saying, hey, go ahead and pick up accrued interest. We got to do it. It's an adjusting entry. It's basic maintenance, account maintenance. And so when we come back on Tuesday, we'll talk a bit more about that, particularly as we go over to talk a bit more about deferrals. And then we'll hopefully get deeper into this chapter and talk a bit more about contingent liabilities. And again, we're going to miss a day next week, but it's kind of the way the calendar works. And so I will try to supplement that with additional videos. So if you have anybody has any questions, feel free to get with me. I'm here all week and happy to answer questions. And so if you don't have any questions for today, I will see you all next week.